I'm joined by Pankaj Mathpal, who's the MD of Opna Money Managers. Hi, Pankaj. Good evening, and it's time to get our viewers' portfolio queries checked. And for all the viewers who's just joined in, you can just note down our WhatsApp number, just in case any question about any of your financial strategies. If you want our help to align those strategies with your financial goals, you can WhatsApp us your queries on 8657974571, and the email ID is themoneyshow@etnow.tv. Okay, Pankaj, let's begin and let's take Sanjay's question first. And he says he has a portfolio of 1.6 CR built over last 10 years. Around 40% of his portfolio is equity, and he's 50 years old. CAGR is around 11 to 12% around 10 years, over 10 years. And he has more than 12 funds and would also like to consolidate them. But then the dilemma is, to get hit by LTCG if he switches funds. Is there any option to consolidate without having the impact of long-term capital gains tax? Interesting question. And how can he do it?
Amita, good evening. See, if he switches from one scheme to another scheme, then definitely an amount exceeding 1,25,000 rupees in one financial year. I mean, capital gain exceeding 1,25,000 rupees in one financial year will attract a tax at the rate of 12.50%. So there is no other way. Only if he wants to switch, he has to pay tax. But the thing is, he should not focus only on saving tax. Instead, if he means changes scheme, rebalances portfolio, and as he mentioned himself that he wants to consolidate his portfolio, it may be helpful gaining more returns in long term. So without focusing much on the tax saving, he should consider realigning his portfolio with his goals.
All right, we don't have him on the phone line, nor we are aware of his portfolio mix. But then, having said that, we just hope he got his queries answered. Okay, so let's move on and let's take Shekhar's question. And do balance advantage funds truly protect you against volatility? And how do they reallocate amid market shifts? A very important question, a very interesting one as well. So yes, talking about hybrid as a category, I think it is called hybrid for a reason, Pankaj. It is called hybrid because you have a good balance of different asset classes, and talking about a balance advantage fund, which has been a favorite of a lot of investors since a very long time now, a good mix of equity and debt in the portfolio. So yeah, I think that's the whole key why anyone would want to have a balance advantage kind of a fund. Pankaj.
The balance advantage fund is a hybrid fund category, and
Sure.
it is also called dynamic asset allocation fund. So basically, the category, these funds invest in two minimum asset classes like equity and debt, and the allocation between debt and equity is rebalanced dynamically. There is no fixed allocation like you have to have minimum 65% or minimum 40%, nothing like this. The balance between the equity and debt can be managed depending on the situation. So there are many valuation models, and in general, when the equity valuations are expensive, the fund manager they reduce the allocation equity and increase in debt. And when the valuations are cheap, that time allocation equity goes high. So in that way, they try to protect the downside, but there is no guarantee that it will work because there are different models, different strategies. Some are counter-cyclical, some are pro-cyclical. So when you invest, you have to keep in mind that your money is also in equity, and sometimes the equity may be between 0 to 100%, means up to 100% some schemes. So there will be a risk of volatility. But as I mentioned, that fund managers that try to rebalance the allocation between equity and debt dynamically, there are chances that they will be successful in minimizing the volatility.
Okay, but then talking about having different strategies as per different market trajectory of movements, I think this is normal for all fund managers, Pankaj?
See, if a fund is like, for example, aggressive hybrid fund, there the equity allocation has to be minimum 65%. But in this category, the allocation can be, it can vary from time to time. Second thing, as you said, for all fund managers, no, see, as per SEBI guideline, the equity allocation can be 0 to 100% at any time, or can be in debt 0 to 100%. But the fund houses, they have made their own strategy. Some have capped between 30 to 70%. So equity allocation will never come close 30 or will never go above 70. At the same time, another fund house may have the strategy like 20% to 80%. So it may vary. But from the taxation point of view, all the funds are managed in such a way that they will qualify for equity taxation. Now the question comes, if the equity allocation is below 65%, how they will qualify for equity taxation? So here the answer is that they has it with the derivatives. So applying the derivative strategies or arbitrage opportunity, they try to allocate minimum 65% gross allocation, though the net allocation may be lesser than 65% in equity at some point of time.
All right, let's move on and let's take Mr. Dattatreya's question. And he's asking, why do ALSS funds offer tax benefit and not other funds? And how are they different from other mutual funds? Very basic but very important questions, and I appreciate Mr. Dattatreya for having asked these questions, because for people, especially the first timers, Pankaj, they might really wonder if they really think about their investments or investing in mutual funds. I'm sure these questions are very common.
Exactly. Kavita, see, equity linked saving scheme, basically the name suggests, it qualifies for tax saving. So why it is different? See, as per SEBI guideline, first thing, any ELSS fund has to allocate minimum 80% of its asset in equity or equity related instruments. So major allocation will be in equity only. So it's a diversified equity fund. Now, why it offers tax saving, not others? This is because it is notified by Central Board of Direct Taxes for this purpose. And because of that, it was notified for this purpose that if you invest in this scheme, so under Section 80C of Income Tax Act, up to 1,50,000 rupees deduction can be claimed under old tax regime. So there will be a 3-year lock-in. So when you invest in other open-ended equity scheme, there's no lock-in. You can exit any moment. But in this scheme, once you invest, minimum for 3 years, you have to stay invested. So simply, one condition has been put here that your lock-in will be minimum 3 years. And second thing, that it is notified by the central government for this purpose, by the CBDT for this purpose.
All right, let's move on and let's take Mr. Clifford's question. Do we have him on the phone line? Mr. Clifford? Okay, I don't think we have on the phone line. But Pankaj, the question is that he has an existing home loan for an under construction apartment, which he's scheduled to receive the possession by before December 25, and he has an existing mutual fund investment. The query is, which option is better, to redeem the mutual funds and pay off the home loan, or to square off the capital gains or continue paying EMI and invest extra in mutual funds and then pay off the home loan? Very interesting question, and everyone who has a home loan on them, might just want to strike out a balance between EMI and doing their SIPs for their investments. Should we stop our investments, or whatever corpus that has been accumulated, should we just pay off the loan? I don't know whether he's into the old tax regime or not, but then having said that, tax benefit on a good loan like a home loan is really advantageous. But having said that, what should be your strategy? Should paying off the loan be your priority, or continuing your investments and then also accumulating the corpus to pay off the loan in lump sum can be the plan?
Exactly. See, one should balance between EMI repayment of loan as well as in the investment. So here, if you see, if he can afford his EMI easily, my suggestion will be that he should continue paying EMIs for his loan. At the same time, he should continue his investment. The reason is that you have different goals, and for different goals, you have to build a capital. And one more thing, because the loan is for long term and rate of interest is very low at this point in time. So my suggestion that if he can afford the EMI, he should continue and stay invested. With the capital, out of that, for other goals also, you can align that investment. At the same time, if he has some surplus in future, he can plan to repay his loan earlier than the tenure, which is what he has decided right now. But at this point in time, my suggestion would be that he should not think only about the repayment of home loan. Second thing, as you said, about the tax benefit. See, in most of the cases, even after repayment of your interest for home loan, the total deduction may not be helpful for getting you such benefit that you are better with the old tax regime. So considering that fact also, means individual taxpayers can definitely compare this. But my suggestion would be that after comparing this, if you are better with the investment and you forego your this tax benefit, maybe that it will be a better choice to stay invested.
Right, Pankaj, I think with that, it's a wrap on the show as well. Thank you so much for taking time out and helping our viewers with their portfolio queries. Thank you. And time to move on, and now it's time for something truly special on ET Now, a leader who's helped shape India's mutual fund industry, a voice investors trust, and a strategist with deep insight into market movements. Joining us as guest editor, Swarup Mohanty, Vice Chairman and CEO of Mirae Asset Investment Managers India. Here's a sneak peek into what's in store as he takes over the newsroom and shares his vision for India's financial future. Take a look.
From managing wealth to headlines, he has shaped investment journeys across India. And now he is curating the newsroom. His views moves markets. And this time, he is setting the agenda.
Hi, I'm Swarup Mohanty, the guest editor on ET Now. Catch me on 21st July, leading the conversation on money and markets, only on ET Now, where you rise with India.